You're looking for a stock that has a 10% dividend yield, but doesn't decrease in value every year like so many of those high dividend stocks do. You also don't want to spend days searching for this unicorn, so instead you came here where I'm talking about that unicorn and potentially other ones too. What you're looking for is a closed-ended fund. What is a closed-ended fund though? Let's get into that. Welcome back to the channel. I'm Jacob Fisher, and today we are talking about, you guessed it, closed-ended funds, along with a few names that you could potentially add to your portfolio if you really want to, or just check out for yourself. I'm not an investment professional though, so this video is for entertainment purposes only. And with that said, let's tap the like button and get into it. First, it's probably pretty important to talk about what a closed-ended fund is, because I only sort of recently learned about it after seeing this article on Forbes. How to invest $100,000 for $940 a month in passive income. And I have to say, that got my attention, and if this video is titled something similar, well, you might know why I did that then. Anyways, a closed-ended fund is a collective investment model based on issuing a fixed number of shares which are not redeemable from the fund. What does that even mean though? Typically with an open-ended fund like most ETFs or other mutual funds, you can redeem shares of the company at any time. But a closed-ended fund cannot do that. Once a closed-ended fund IPOs, the shares they show up with at that market, those are all the shares that are out there. For example, Tesla had an offering back in February where they allowed outside investors to get in as sort of a capital raising event. They needed money, so they sold more shares of the company to investors at a lower price than what was currently being traded on the stock market to raise some of that money. Meanwhile, those people got to own shares a bit cheaper than the market value. A closed-ended fund would be unable to do this, and their shares can only be purchased and sold in the market. However, sort of similar to other funds, they do have expense ratios just higher, around the 1% to 2% range than the typical lower range found on ETFs, or maybe a bit higher for mutual funds. There's another couple of features that distinguish it from mutual funds as well. It can be traded at any time of the day, while a mutual fund, you can't do that. It's traded during a set period of time for a mutual fund. It can trade at varying prices not related to its net asset value, unlike mutual funds, where their funds are traded only at the net asset value. Now with closed-ended funds, you also get an expected net asset value, and the price can change higher or lower depending on what people think of that stock and what they'll pay for it, depending on the supply and demand in the market. If you find a closed-ended fund with a price of $20, but its net asset value is $22, you could technically be getting a good deal because you're able to purchase it at a lower amount than the value that it might be worth. Lastly, closed-ended funds can own unlisted securities. There's got to be some downsides to this, right? Well, yeah, of course there's downsides. There's downsides to any type of investing. There is risk involved. With closed-ended funds, you have risk of the market. You have a pricing risk, meaning you could be purchasing that closed-ended fund for higher than the net asset value and be paying a premium to join this closed-ended fund or own shares of the closed-ended fund. Depending on what the closed-ended fund invests in, you could have risk within that sector if the market goes down. If it's a travel closed-ended fund, I don't think that's out there, but if it is, and everything happens, then you can expect that market or that closed-ended fund to drop more than the overall market. With the Fed lowering interest rates, on another example, a bond closed-ended fund would probably go down a little bit harder because interest rates are going down as well. Since these funds are managed by people who can leverage the money, you could have an enhanced risk with this higher leverage that they're using. With some of the risk comes potential for more growth though, preferably, right? Or in some of the cases, or in some of the funds I'll mention, higher dividends nearing 10%. Let's just get into those funds now. We have GAB, G-A-B, or Gabelli Equity Trust. This has a whopping 9.79% dividend, or 15 cents a share. The net asset value on this is $5.79. So any price below that will be a discount, while prices above this are a premium. Currently, they're trading at a premium at around $6 a share, so it might not be the best time to get in. It is pretty close to the net asset value, but it's still over it. The top holdings of this portfolio are names that sound good to me, but they also have other holdings in food and beverage, consumer products, and consumer services. They use leverage to increase the returns they make, increasing that dividend payout as well. They have increased 11% in the last 5 years. That's just the price of the stock going up. You still get 10% dividends each year along with that it rising in price. In fact, there are a ton of funds run by Gabelli that all offer decent dividends. I'll briefly mention here because the video is not all about them, but just closed-ended funds in general. We have GUT for utilities, GUT, with a 7.81% dividend, trading at $7.65 with a NAV, or net asset value, of $4.15. That's quite the premium. There's GRX for healthcare with a 5.35% dividend, trading at $11.36 with a NAV of 13.37. It's elite. Then the last one I will mention is GGT for multimedia with a dividend of 11.5%, trading at $7.67 with a NAV of $7.88. Let's get into the other two closed-ended funds I found. Kind of ran through Gabelli pretty quickly. We'll talk about these a bit longer. BHK, or BlackRock Core Bond Trust, invests in bonds because that is in the name of it. They choose investment-grade bonds for corporate debt, but they choose larger companies like Verizon, Bank of America, and JP Morgan Chase. BlackRock itself is actually on the stock exchange, so if you wanted to buy in the company that owns this closed-ended fund, you could do that too, under the ticker symbol BLK. If you recognize BlackRock, it may be because they have $6.3 trillion in management under them. That's a lot of money. I don't have anything near that. I don't think anyone has anything near that, actually. One of the largest money managers out there is what they are. Anyways, BHK has a 5.03% dividend priced at $16.14 right now, and its NAV is at $16.36. So a bit of a deal. They've increased 28% in the last 5 years. Lastly, we have QQQX, a fund that does something pretty interesting. If you know QQQ, you'll know it's of the NASDAQ 100, and it's all mostly tech stocks. This also includes all of those tech stocks, but they sell call options to around 35 to 75% of the fund's equity profile. Kind of like the wheel method I talked about in a different video up there. And this is how they generate a decent dividend at 6.13% while holding all of these stocks with pretty low dividends like Apple and Amazon, who offer less than 1% or 1.5%. They can offer such a high dividend because they sell those call options. They're trading at $25.44 with a NAV of $25.93. They've increased 28% in the last 5 years, and their expense ratio is 1.07%. Most of you have probably noticed, as did I, that these funds don't have insane growth rates but provide pretty high dividends, and that would be correct. Most of these funds are around for income rather than growth. Like if you just invested in the NASDAQ 100 or QQQ, you would probably have your portfolio grow more year over year, but you would be earning significantly less dividends. It's all about what you want. While these funds can generally return 10% a year overall with their growth, that's pretty standard across the market. While this is the standard across the market, about a 10% growth, if you want your portfolio to grow more, consider investing in more growth stocks. If you want more dividends, these are actually pretty good, ranging from 5 to 10%. If you're trying to kind of get an income out of dividends, then these are perfect stocks for you because they don't decrease in value all too much. If growth investing is your main goal, you can toss these in your portfolio if you want to. You don't really need to, or you can just invest in the names that they are invested in themselves and kind of steal that portfolio. It doesn't hurt to add a little bit of dividend investing into your portfolio. I know I have a couple of dividends, or quite a few dividend stocks out there. I have Gab, that's one of them, along with just T-Mobile and other actual companies out there. But I wanted to generate some bit of dividends while focusing mainly on growth. Either way, you can add all these to your arsenal of investment ideas for your portfolio in the future or now, depending on, again, what you want to do. Let me know your thoughts about these in the comments below, and if you would invest in any of these closed-ended funds. I upload videos on Monday, Wednesday, and Friday on travel and finance, so if that sounds like something interesting to you, make sure you hit that little subscribe button down there. Thank you so much for watching, and until next time.